We're live again for another episode, another day, another dollar. And today marks an interesting day, I think. Though there still may be more pain ahead, I started buying the market today. I bought Google, Microsoft, the NASDAQ. I nibbled a ton of Meta. And then after hours, earnings were released and all of the big tech have shit the bed. Google missed, Microsoft missed, Meta missed big. After hours, we're talking a 20% drop. Today, 26% drop on the share price from upwards of almost $350 a share down today to maybe tomorrow breaking $100 a share. That's like more than 3/4 of the entire market capitalization of Meta. And by the way, Meta is WhatsApp, Instagram, Facebook, and the future of the metaverse. They're probably one of the strongest, players in that space. And we are moving towards a metaverse reality, integrated with, I think, some of the technology in the blockchain and the NFT world. The future is in the metaverse, I strongly believe, and they are a cash flow machine. They have more eyeballs and attention on their apps than any other technological company except for Google. So interesting. The average person spending a ton of time on Facebook and Instagram. So I bought shares and I'm getting crushed. Wish I bought it tomorrow. I'm going to probably buy more shares tomorrow. I am still net short the market, meaning all of my long shares minus all of my short positions, I'm still net short the market. So I'm still shorting the market, but I'm starting to buy the dips. I bought Google, I bought Microsoft, I bought Meta. Wish I didn't buy Meta, but I feel fine about the fact that I bought Google and Microsoft. And in the long term, I'll feel really good about my decision to buy Meta, I think, in the next 5 years. As I hold those shares, I think I'll feel fine buying Meta, at $100 a share. Who knows? We're talking about a 10 PE ratio right now. It's producing a ton of cash flow. It does have a lot of potential growth. Who knows? At the end of the day, who knows where the market is headed the next little bit, but I think it is getting closer. Today, we saw the Bank of Canada announce a rate hike of 50 basis points. The market was pricing in and expecting 75 basis points, with many venturing out to say we needed a 100 basis point rise. That will have implications. For one, we should see a bit of a short-term interest or peaking of demand for real estate, as well as for mortgages. It'll be overall a bullish signal. The Fed is, well, at least in Canada here, the language is very dovish. It's not as hawkish as we would have expected. I would have preferred to see a 75 basis point hike at least. I want to see them get inflation under control quickly. I want to see pain now so we don't have pain for a long time. So I really feel like there's an opportunity here to, well, there's a couple ways this could go. One, it could be that the Fed now begins to pivot and get more dovish. And so we get to the end of the rate hikes. And I've said all of this year, the bottom comes when the rate hikes stop and they start stimulating. So are we there yet? Soon. I don't think it's a bad idea to start nibbling in on some of these dips. I think that there will be bear market rallies. So my personal forecast is, based on all past evidence I've seen, people suck in government. And the Fed especially sucks at doing everything. They overprint and then create inflation that runs out of control. Instead of addressing it last year, they wait until it gets to a point where it's out of control, and then they overreact and they cut rates too hard as well. So I think what'll more likely than not happen is there'll be a sort of a seesawing motion where there's, or sort of a back and forth where they go hawkish, dovish, hawkish, dovish, hawk. So it's a slow and painful fight against inflation that lasts a couple of years, as opposed to a snap recession, boom, stimulate, back to low interest rates. I think there's going to be a battle back and forth where they're like, data's lagged. Let's take it easy, guys. Oh, you know what? Inflation's going crazy again and people are buying. There's tons of capital. Oh, you know what? We need to stimulate everyone because we're going into a recession. Oh, you know what? So I think it's going to be a battle back and forth where we continue to struggle with inflation in the coming years. I think we're in for a rocky 5 and 10 year period. I don't think we'll see the kind of bull market we saw in the last 10 years. That said, there can be a lot of opportunity and variance in the movement, in the variations and the bull runs and the bear troughs. We're going to have a lot of volatility in these times. So it could be a good time for people who are smart to make a lot of money. And so be smart. Don't deploy everything. Keep some cash back, but start edging into the market. I think this is a good time, especially in real estate. If you can negotiate really great deals, now is a good time to get in and do that. You guys know I've started to go hard on buying properties. I have a lot of flips on the go. I'm also looking for long-term holds. I'm not so interested in, you guys know I've invested now into the Airbnb space as well. We have a business now where we're working in that space. So my flip business, my Airbnb management business, technically my social media business, I guess, is all me investing into real estate. And I'm putting my money where my mouth is, and I continue to buy properties. We're now scaling that up at a rate that we weren't before. So actively acquiring properties right now. Does that mean you go all in? No, I think it means, at least in the models that I'm running, when I'm buying real estate, I'm looking at, we used to run our models where we'd assume appreciation is 3 to 5%. Now we run depreciation. So next year we expect the market to drop another 5%, and the year after that another 5%. And so not even expecting zero, but expecting depreciation of the asset on average will allow you to buy smart. And so when the market does correct further over a 5 or 10 year period, you are laughing because you bought at such a great deal and you capitalized on the fear to negotiate a great deal now. So sometimes you can use fear to negotiate really great deals, and there are opportunities and variances to buy below market. So the key is, if the comparables tell you the property's worth $300,000, pay $200 to $250. If the property's worth $1 million, pay $800 for it. And that sounds crazy. People are like, how do you do that, Mike? That's what I've been talking about on this channel for years, right? That's the skills required to execute at the level you need to be executing at to build a successful real estate business. You need to be a good negotiator. You need to be finding ways to add value to the property. It can't just be buying a turnkey new build from a developer, paying top dollar, locking your deposit up, and expecting that in 2 years, you're going to walk into this property with a double in your down payment. Those days, anyone who got into that this year has realized quickly that their entire down payment's gone. And we're now in a market where that strategy doesn't do as well. That easy free money strategy that requires no skill, that doesn't do as well in this market. And I'm glad, at least part of me is glad. Sure, I'd prefer a bull market, but I like to see the good operators get rewarded. And I like to see those who aren't good operators, who let costs run out of control, who hire expensive contractors and just write a blank check to them. I like to see them get punished because they overspend on their flips, and now they're getting burned because they can't sell them for top dollar anymore. They're sitting on the market and their carrying costs are high because they didn't focus on cost reduction. They didn't focus on a lot of the key executing factors you need to profit. So it'll be nice to see the operators. Everyone's margins are going to get squeezed, but the good operators are still going to have a profiting margin in this business. So, and then when the market does finally recover and rates do come down, I don't think it'll be a rapid acceleration like we've seen in real estate. I think it'll be a slow, drawn-out period, a lot like the 90s, a lot like in the 90s. In Toronto, if you bought a house in 1992, by 2002, that house was worth about the same amount of money. For a decade, you would hold a property here in Ontario and Canada, and you'd have almost no appreciation. You'd renovate it, put 100 grand into it, and it'd be worth 120 grand more after 5-10 years. No more of like, you put in 100 grand, the market appreciates like crazy, and you make $500,000 on a property, and you double your money over a 5-year period. That kind of investing, I think those days are ahead of us, but not in the short to medium term. So in the short to medium term, we're in for a rocky economic time. So it doesn't mean that we can't still invest. Doesn't mean we still can't make great money. Doesn't mean you can't house hack, buy a property, rent parts of it out, and live for free. That's a must. Doesn't mean you can't rent hack, as an example. Rent a property cheaply and then live in it, or just re-rent it on Airbnb or co-rent it. There's still ways to get your living costs way down. Remember, the secret in this channel, I talk about it every single time, has been to spend less, earn more, and maximize returns. And talking about that personal finance formula, it is the formula to building wealth. People are like, what's the secret to personal finance? I'm like, that's it. I just distilled it down to like a small sentence. It's literally what you spend, what you make. The difference is what you're saving and investing. And then over time, how much you invest and how you invest become more important. In the beginning, it's all about what you're spending and what you're earning. So you want to make as much as you can. But in this type of economy, that advice is now prudent for large operators too, like Meta, as an example. There's Meta, Google, Microsoft, Netflix, all of the big tech. They need to cut. They need to fire people. That's what the analysts are all saying. That's the writing on the wall. They're spending like they're in a bull market. We're in a bear market, and you can't control top line in the same way that you could in a bull market. In a bear market, your margins are squeezed on the revenue side, and in order to stay profitable and to stay, a top operator, you need to be cutting costs too. So the days of like, I'll just earn more money, that mentality is great in a bull market. And it's great if you're a high income earner, but there is a time where watching the bottom line is important. I think that's always, but now more than ever. So we'd love to see, I know I'd love to see, and many other analysts that follow would love to see Google, Meta, Facebook, we'd love to see those guys cut, fire people. That's what needs to happen. And then the resulting year or 2 or 3 is a slowdown in the overall economy because of the firing. It has a trickle-down effect, right? Sorry, guys. Throat's killing me here. Oh, got some questions here. Hello, Marley. Brandon says, thoughts on the open letter to Meta. I honestly haven't read that open letter, so I can't comment on it. I'll have to read it and get back to you. Port City Trading says, what's the worst scenario if they see inflation is still running rampant? So, well, it depends, I guess. The data is always lagged, right? And it's month over month changes that they're so focused on. But if inflation does peak again, let's say it is going down, especially in Canada, we're trending down, which is good. But if we do have a peaked period through this winter, let's say energy prices get crazy and it drags up the cost of things, rent crazy, the cost to service your mortgage for most Canadians who are on variable rate products, or trying to buy a new home, again, crazy. So if we have a high inflation reading, then the Fed has to go harder. There are basically 2 ways they can control inflation, supply side or demand side. And the Fed has chosen to address inflation solely demand side. And so they want to crush demand. And the way you crush demand is you hurt people until they can't afford to spend. You say, oh, you can still afford to pay that much for goods? Companies won't drop their prices until people can't afford to pay. So they have to make it to the point where people and businesses can't afford. They can't afford to spend on Facebook ads. They can't afford to spend on the new car. Car price has to drop. They can't afford to spend on gas. Gas prices have to drop. Same with housing everywhere. Every sector has to be negatively affected. You have to effectively starve demand to get inflation and prices down. You could tackle supply side, but we won't get into that because they don't want to get into that. How do they handle inflation running? To answer your question, they will really, the only tool that they have in their belt is to reduce spending and raise rates. Now, if they decide like the UK did, where they pivot and start buying all the bonds, or like Japan that has a negative interest rate right now, because Japan is basically buying all of their own bonds. There's almost no trading of their own bonds actually in the public markets because the only buyer of their bonds is themselves, forcing the rate down by buying all their own bonds, artificially keeping interest rates low because their whole economy is very much closed now and predicated on very, very low rates. They can't afford rates to go crazy. So that's what the government could do. They could raise rates and then it's possible that confidence could be lost in the government. The government may have to then stimulate the people as well because people are suffering, right? Basically, when you raise rates a ton, what you find is that people suffer. They can't pay their home equity lines of credit. They can't pay the line of credit. Businesses all tighten their belt and they lay people off. It creates economic hardship, right? It crushes real estate, crushes the stock market, crushes the bond market too, really, because anyone who agreed to a bond coupon rate of say like 5% or whatever, and now it's 7%, well, try getting rid of your bonds. No one wants them because your bonds are at lower rates than what the market's paying now. So then it's just bad all around when they raise rates. And so as they raise rates, they hurt the economy. And it's very likely that, okay, so my personal take about why we saw a 50 basis point hike today instead of 75 basis points is the NDP Liberal majority government coalition. They really don't want rates to rise. It's a political nightmare. And we're also going in the US into a midterms election. And so there's a lot of political pressure on the Fed, and to pretend that they're independent, they're not. There's a lot of political pressure to slow down the rate hike. It's too fast, too much, too soon. And so there's a political pressure from a lot of their party members that are in control to slow it down. If the Fed doesn't listen and they go too fast, which is supposed to be their job, their sole focus is supposed to be fighting inflation. And fuck the economy, real estate, people's jobs, like that doesn't matter. Their focus is inflation, because inflation running wild is worse. And that's their sole focus, is like, everything else will recover. We've got to get inflation under control. The economy be damned. And so that's supposed to be the mindset that the Fed's supposed to have to keep inflation under control. However, the political pressure is getting them to be more dovish. I think they're taking it slower than they need to be. I want it fast, rip the Band-Aid off and be done with it. But I think they're going to drag it out into 2023, which means we're not going to get back to normal until 2024, 2025, maybe 2026. This could drag out for years, especially if the government steps in and says, hey, we're going to print a bunch of money and stimulate people. We're going to give you stimmy checks, pay your hydro bill, your gas bill, because you're suffering. We're going to hand out student loan forgiveness. We're just going to hand money out. The more they print, the more the inflation runs wild, the harder the rates need to come up. So it's conflicting. It's conflicting information, conflicting motives. And so it may drag things out longer than they need to be. And it may make the recession longer and more drawn out. I would rather we have a steep and then a back to like a big V. That's what I'd like to see. I don't want a W. I don't want this to keep going. I don't think any of us, well, I don't know. Everyone's got a different opinion, but I don't think any of us really want this to drag on. But such is life. Next question. Oh, that's a good question. I'm going to pick this one off before the other ones just because I saw it pop up right now on the chat. Were you a big Triple M reader? Thoughts on the FIRE movement? So yes, in 2010, I was obsessed with Early Retirement Extremes, Jacob Lundfisker, and then eventually into Mr. Ray Mustache's blog, where I read pretty much every single post he had to post. This is maybe in 2012. And I was like, maybe 2011, 2012, I was like big into everything he'd written. And I was like, hey, I love this movement. This is the solution to all of the problems that we have. Everything, at the center of everything, there's capital and money. Like money is the center of everything. How you control your time, everything roots around financial. Once you've mastered the financial lever, you can do the rest of your life however you want, and you can just have an amazing life. But you gotta have your money right. If you don't have your money right, you can't have a good life. No one's living a great life in poverty. Unfortunately, it's a necessary evil. And so when I found that blog, I was like, wait, you can retire early in your 20s and never have to work another day in the rest of your life? And that like you could have enough by simply retooling your brain against, the ideals of materialism, again, becoming more anti-consumerist, becoming more minimalist, even if you're not fully minimalist, but just subscribing to the fact that stuff doesn't make you happy. That new watch, that fancy shirt, the new car that's a 2022 car versus the 2014 car. They both get you to point A to point B. The 2014 car costs you $4,000. The 2022 car costs you $40,000. One you can buy in cash, the other one you have to finance. It's going to cost you a ton of money in this environment. One's going to cost you a lot less in insurance. It's the older car. Total cost of ownership, much, much lower if you buy a car with low miles that's like 10-year-old range. You can sell that car every 3 years, buy another car that's the same age approximately. So then you buy like a 2017 car 3 years later, and it would again still be like 10-year-old car, 8 to 10-year-old car. You can drive that car for nothing. You sell the other car for what you bought it for, and you use that basically deposit to buy your next car. Anyway, all these sort of hacks that I dived into in the FIRE movement got me to retirement. That's how I retired at 24. I've now been retired for almost 6 years. So I've had passive income from my net worth, able to generate more than what I ever spend in a year. So I've been technically retired. I went through phases where like I sold all my real estate and I was retired for a year. I just was gaming, hanging out, having a good time with my wife. And I had one daughter at the time. Now I have 3. For me, it was just about like finding that point. And when I got there, I still wanted to do stuff. I was like, oh, I thought this retirement dream that I had, I did it in 5 years. So I subscribed to the ideal at 17. Oh, no, okay, I subscribed at 17, 24 I got there. So it took me 7 years to do it, to retire early. I was one of the earliest, one of the youngest. At 24, I'd found no one that had found the FIRE movement and done it by the age of 24. So I got lucky that I found it early. And then I just grinded. I lived on 10% of our income. I found ways to house hack to get all of our costs down super low. We didn't enjoy, lavish life. We were very, very frugal, very much focused on the house hacking allowed us to live for free because I had roommates and I rented the basement to pay off our mortgage every single month so that we didn't have any housing cost, right? Yeah, I love the FIRE movement. Big, big kudos to the movement. It's just that I've grown past it. I got a lot richer than anyone. Like all the people in the like Mr. Ray Mustache and all those guys, I just started making way more. Like I found that I had high income skills, and in real estate, I was able to apply myself to make 7 figures a year. And when I was making that kind of money, I was like, "There's no one else in the community that's talking about LuxFire." And so then I was like, "Well, LuxFire is sort of the next thing, the next evolution. If you've gotten through lean fire, regular fire, and now you're at like the Lux financial independence, retiring early. There's definitely levels to it, right? And I think that even being lean fire or like a super frugal version of the financial independence, retired early, where you don't have to go into work and you're not as like a wage cuck, that's like still a good life. And I would prefer that over a job all day. I just wanted more, and now I just have fun in the challenge of growing. But I could stop tomorrow, sell my assets, and live off my passive income and never even come close to even spending it. I'd probably still be like 3/4 of what my passive income, what I make in passive income, would be just reinvested. So like I couldn't even spend the passive income. So there's no reason for me to be actively trading stocks. There's no reason for me to be like, and I know that actively trading, I know the data supports that 99% of active traders don't beat the market. So what am I doing trying to beat the market, right? Trying to pick individual stocks. Buy the whole index, don't look at it. Like there are businesses though you can invest time and you can make a greater return. Like I could in a lending business make a extraordinary return. I can in a real estate business, acquire deals under market value, put time and effort, build a business around transforming those properties, like a construction company effectively, turning properties around and running an active flipping business. There's money to be made in those businesses. And I continue to make money in those businesses and they give me extraordinary returns. But I don't need to have those extraordinary returns just because I want to be a billionaire in my life. And I've set this new goal, this challenge to try to, I have certain landmarks that I got. In my 20s, I wanted to hit 8-figure net worth. In my 30s, I want to hit 9-figure net worth. In my 50s, I want to get 10-figure net worth. And so that was kind of the goals I had set out. It's really hard to go from 9 to 10 figure. That's the really hard job. So probably it'll take me till I'm in my 60s to be a billionaire. Realistically, unless I have some successful business venture or something that has like a 10x return, you need some really crazy returns to get to billionaire status. But I suppose just starting really young and compounding at 13% should deliver that. The problem is, as you get a huge base of capital, it gets harder to beat the market. So it's easy to get 13% return when you have like $5 or $10 million bucks. So you can get out there and do that. But when you have $1 billion, it's really hard to get a 13 or 15% return because when you make moves, you buy whole companies. If there's an arbitrage opportunity, there's only so much of that arbitrage. There's not enough arbitrage opportunity out there for a large pool of capital. So it gets harder and harder to beat the market as you get, like if you run those fire sim simulations, or fire sim simulations where you would map out how your network's going to grow over time versus what you're spending. You can build sort of a whole simulation on a chart. I used to live in those charts and like play with it and be like, oh, if I could get my savings rate up like 3%, and I could by reducing spending here and I could go to a tax haven, and then I would have like 35% more income. And it's like mapping out what happens if I live in like the Bahamas or Costa Rica in a tax haven and how that plays out on my net worth over time. But a lot of people falsely make the assumption that they can continue like a 15% compounded annual growth rate on their invested capital in the later years. And in the later years of the simulation, it gets harder. So your returns actually should go down over time as your net worth gets huge. That sounds weird, but like Warren Buffett, as an example, has a really hard time being in the market because he has so much capital. There's like if you gave Warren Buffett like 100 million, he'd be able to find a lot of deals to deploy all that and get extraordinary returns. But you give him like 100 billion, there's not enough opportunities that exist to arbitrage to get those crazy returns. Like let's say I had a lending business and I had a great network of people, of flippers. There's only so many flippers willing to pay me 20% interest, right? Eventually I have to lower my standards and find flippers who will pay me 12. And you know what I mean? Like there's just not enough of those opportunities out there to deploy all of the capital as you become huge. Unless you get into private businesses. And that's basically what every billionaire does, is they get into private business ownership. And that's where they can get extraordinary returns by investing, in certain things that give them a competitive advantage above the market. But anyway, long divergent, tangent. Sorry about that. But I like that question. It was a good one. I love the Mr. Wayne Mustache blog. I haven't been on it in years. I haven't been following what he's been up to lately. Occasionally, maybe I was. Earlier this year, I think I checked in on his blog. There was a post that was emailed to me. I saw he was doing some cool stuff with renovations and living his best life and whatever. Good for him. Honestly, I considered him a mentor for a number of years around frugality. It's just that my passive income has gotten so large that even if I spent like 100 grand a year, there's no, what's the word? For me, and this is just for me, but there's very diminishing returns from investing in frugality, investing my time into frugality. When I can spend an hour coaching someone at $1,000 an hour, it's really hard to want to be frugal at the grocery store and save $70. Like as an example, I subscribe to Instacart and the groceries get delivered and brought into my house. I don't even go to the grocery store anymore because it's an hour of my time with if we go with the kids or if I go to the grocery store, it's like an hour and a half of my time. I can use this app called Instacart and we can literally price match on this app and someone at $10 an hour goes and gets your groceries. It's a membership, it's like $200 a year. Like my time's just not worth $120 an hour and I'd much rather do a coaching call and improve someone's life, like $500 or whatever, and then just pay $10 to the Instacart person. I'm up $490. So for me, frugality is really hard. I'm still very frugal to the bone. People who know me are like, if I have two options at the restaurant, I'm still picking the cheaper option. If I have a coupon, I'm still using the coupon. Like if I'm gonna live my life and get a deal on that thing, like if I'm gonna, buy a flight and I can find a flight for $200 cheaper, and it's like simply going to their website, and I had to do it either way, I'm gonna go with the frugal option, right? Same as being a Renaissance man. Some of the, the core tenets of financial independence, retiring early, is like being self-sufficient, right? And trying to build your own ecosystem where you're not reliant on other services and things, right? But as an example, if something was broken in my house, it might be faster for me to actually go in there and like repair the plumbing leak myself because I have those skills. I can use those skills from being in construction for the last decade. I understand construction. So for me to go and call a plumber or two, get them to come out, sit there while they do the work with them, then send them a payment after, all of that takes more time than me just fixing it myself in a half hour. So sometimes I still get down on my hands and knees and I do things because it's a net time savings and it's a money savings bonus. Like, why not try to save money where you can? But I'm not going to go out of my way to spend extra time now in the ways that I used to. The old Mike would spend 2 hours on the phone between probably 6 hours on the phone. And I did do this, by the way, in my early 20s. Like when I was like 20, 21, I just graduated from Ivy, my 4-year degree. I was working in consulting. Every dollar counted because I only made 50 grand a year my first year, 55 second year, 60 plus bonus third year as a manager. But in those times, every dollar was getting invested in real estate where I could double and triple it. So if I could go and I'd be on the phone with insurance companies, I'd call 6 companies, try to fight for the cheapest car insurance. We always shared a car because like even now, like why have 2 cars? Just a waste of the environment. We can get by with 1 car. We're a car sharing family. But wherever it doesn't impact my life in a great way, I don't mind, trying to save money. So I would call the insurance companies and I get out there and spend like 6 hours fighting with insurance companies to get different quotes and play them against each other. And same with my mortgage rates. Be out there like shopping them against 4 banks, trying to get the cheapest rate. And all of that allowed me to save thousands in the beginning. That's become hundreds of thousands now. Because when I was able to save 10,000 at 21, I'm now going to be 30 in a couple weeks. And so over that last 9 years, I've compounded and invested that and turned that into a lot of money. And so people think, oh, just $100. Oh, it's $1,000 here. Call your insurance companies. I guarantee you, if you call around, you get your home and your auto insurance down by 30, 40% just by shopping it around. And like over a 10-year period, that's probably $20,000, $30,000 in insurance costs. And if you invest that and compound that, we're talking 6 figures just lost to insurance that you're probably never going to claim anyway. But it's good to have insurance, and I understand the value prop in having insurance in case you get sued or something. It's nice to have them. Right? Your properties, you need it by law for your car, so you have no choice. But anyway, all that kind of stuff. I used to shop around for all that stuff to find the same thing but for less. And it applies to anything. Like I can go on the market and I can find the same 2006 Honda Civic for $2 grand, and another one Granny's selling for $1,000, and another one some guy's trying to sell for $4 grand. And in a lot of cases, they're actually comparable. It's just that the one person's not a good marketer, and they just want to get rid of it quick, right? So for me, it's about spending a little bit of time to save. Like on a car purchase, I went out there and we just bought a Honda Odyssey. It's a really great van. I never thought I'd be that minivan family guy, but I am, and I love it. And I'm like, oh my God, look how much space is in this car. The sliding doors are awesome. It's weird because I have 3 kids now, so we're in a different world now. But even there, I spent like probably too much time, honestly, shopping for that Honda Odyssey. But I was able to find one at a dealership for like 28 grand, and they were going for like 38 everywhere else. So I saved 10 grand. If I'd spent 10 hours, it's $1,000 an hour. It's a great use of time. A lot of idiots will walk into the first dealership and they'll just buy the first car that they're sold, right? They just don't try. They don't look for a deal. They just accept that like the first place I walk in, all the places are the same, all the dealerships are the same. I'm just going to pay this price and be done with it. And that's a horrible mentality. That's the anti-fire mentality. That's the consumeristic mentality that's going to keep you spinning on the hamster wheel, stuck in a job, working to pay for stuff that doesn't bring you any happiness. And you're unhappy because you have no free time, because you're working a job that you hate, and it's an endless circle, round and round and round you go. Financial independence, retiring early, the FIRE movement is an escape from that wheel. You can be your own entrepreneur. You could do nothing if you want. If you just love to like go for hikes, go for bike rides, and watch movies, you just do that in your early retirement. Like there's times where I take sabbaticals and that's all I do. I just hang out and like binge watch shows. I get a lot of value from growth, from building businesses and negotiating. And I get such a high off of arbitraging. And it used to be like I would get that high from saving money. I go to the grocery store and like I'd price match, use coupons, and we get like $200 in groceries for like $90. And that used to give me such a high. Now I like to do that with real estate. And I'm like, oh wow, I can do that same thing with real estate, but I can negotiate on $1 million house and get it for like a 6plex or a 10plex and get it for 800 grand. And so that time I spent is such a bigger payoff now. And so it's hard to want to negotiate the groceries for $200 when I can just spend that exact same time negotiating a deal and then wholesale it to someone else, like assign the contract to someone else. There's like, hey, maybe I don't even want to close on that 10plex, but someone else is like begging for a multifamily property under market value. And they're like, Mike, I'll split that difference with you. Like I'll give you 50 grand, just hand this contract to me. So that's when I started wholesaling. I was like, oh, I can just assign these deals that I find. Other people want them. Even if I can't close, I don't have the money or the time or the energy to take that deal down and transform it. Someone else does. And that piece of paper is valuable. And so that's when I got into assigning contracts and doing wholesale. Yeah. All right, back to the Q&A. Let's see. Port City says, what's a worst case scenario if they see inflation still is running rampant? I think we answered that question a minute ago, but there are a few worst case scenarios that play out. It basically just means we get back into a late 80s type of situation where rates have to continue to rise to a point of double-digit returns. So, or double-digit cost, I guess, depending which, if you're a lender, you're like, oh, double-digit returns. If you're a borrower, I suppose, then it would be double-digit costs. So a lot of businesses, a lot of people would be forced to pay really high rates at 10, 12, 14%. A lot of things would grind to a slowdown, right? As an example, the government would need to tax the hell out of everyone to pay the cost of, almost every first world nation is in debt up to their eyeballs, right? To other countries, like they're all in debt to each other. And so as the global rates rise, that creates a real problem where the government can't afford to pay its own debt. So the worst case scenario that plays out is a really high inflation environment everywhere. And in some of the third world countries, if the US gets to 10 or 15%, third world countries will be at 50 or 60% inflation. Like their currencies are literally collapsing. The result of that is typically war or famine, but usually war. So war is probably the worst case scenario that results. Probably a global world war is a worst case scenario. So that's why it's smart to buy some shorts or buy some puts, sorry. You know what I mean? Like sell some deep calls once in a while. Probably just buy some puts in case everything goes fine. The puts are there for the black swan event. You take 1% of your portfolio, you buy some puts on the market. And if the market collapses, those put options you spent 1% of your portfolio on, if they go to zero, who cares? It was 1% drag on your return. Who cares? You can afford to lose 1%. But if they pay off and we have in a recession, that can really happen, especially now we're in really interesting times, those puts will be worth 100 times or 10 times at least what you paid for them in some cases. And so that can be like your black swan Hail Mary, and you take that capital and use that to buy the dip and to have cash. So there's a book called The Black Swan. Look into black swan events. There's actually a ton of research done on people who do that, who take a small percentage of their portfolio and they hedge with bought puts, and they actually win. Because during recession times, the cost of the 1% a year for that hedge, especially if you apply it during only recession times, you end up with a huge return. So puts and calls. So it's just basically options contracts, futures contracts. An option contract basically gives you the right to be able to put shares or have shares put into your account. So effectively, if you, as an example, if you've got puts on the index, if you sold a put, then someone can put those shares into your account, is a way to think about it, at whatever strike price you agree on the contract. It's like insurance. So you can buy insurance, you can sell insurance. The same is true on the call side. You can have shares called away from you, or you can call the shares that you want. So if you wanted to buy Meta at $90 and you didn't have the money to buy a whole share, as of this morning, you probably could have bought $90 puts on Meta, $90 calls on Meta, and then you'd have the right to be able to call the shares, which those calls would be really expensive to buy this morning, but now tomorrow morning they'll be probably pretty cheap to buy those, right? Because the stock's crashing 20% after hours on really bad earnings, which the earnings weren't even that bad. It's like they need to cut expenses, and like no one believes in the metaverse yet. That's it. They're a cash machine, like a 10 PE ratio. But anyway, and they have the eyeballs of the world on them. 2 billion eyeballs on Facebook, Instagram, WhatsApp. Like they literally have the world's attention, literally speaking. Like we all spend 6 hours a day on our phones, right? Like, and we live on Instagram, Facebook, WhatsApp, right? Like that's how we communicate. So anyway, as a company, I think they're not going to zero. That's for sure. And I think the metaverse is the future. We're early. They're early and they're spending too much, too fast. They need to slow it down. Research and development's important, but they need to cut the costs in this time. Cash is king. Anyway, that's just my personal opinion. But yeah, what's a worst case scenario? That's the worst case scenario. And so what's a put? Then you definitely need to be, just have a Google search about that. So you can go into if you have an interactive broker's account, you can just do a quick course and you can understand basic puts and calls. And there are also ETFs that you could buy that simulate the futures and options contracts for you that operate 3-to-1 or 4-to-1. And you can have those in your portfolio. There's a small percentage of your portfolio that's there to hedge. Like you can literally short the real estate market if you want to right now. There's ETFs that play the market 3 times down. So if you believe the real estate's going to correct another 20% in say like Florida, because Florida's still pretty flat in some major cities like Miami, you can just buy those. And if the market goes down 20%, you make 60% return. You could hold that ETF in your portfolio. And then when you see there's, the next 2 years as real estate kind of comes down a little bit, you could profit big time just by holding those ETFs, exchange traded funds that will do it all for you. You don't even have to play with the contracts at all. Anyway, there is a great deal of research that supports hedging, and having those backup contracts as insurance against your stock portfolio is a great idea. So you can insure your stock portfolio. If you wanted to, you could buy the index and ensure that you never lose more than 5%. You could hold the S&P 500 with options contracts and never lose more than 5%. But you'd also cap your upside. You might be capped at like no more than like 8 or 10% growth. So you won't get any crazy upswings, but you won't get any crazy downswings. It's called straddling. People build portfolios all the time. You can even buy into funds that do it automatically for you where there is no downside. Insurance companies do this with whole life insurance, universal life insurance. They basically use options to do the exact same thing, and they ensure that there can never be a 0 year. They make sure there's a stop loss in place. So a lot of people are afraid of the stock market because they're like, oh, I could lose money. It's like, you can invest in the stock market with a stop loss, right? So you get a guaranteed upside no matter what. You can't lose. Now you're going to give up a lot of the upside. Like you're not going to get if the market rips 30% up 1 year, you're not going to get that 30% upside. If it goes 30% up, you're stopped out because you bought insurance and you agreed to give away any of that extra gain on your portfolio. But you can basically create a band where you can keep your stock returns. If you're cool with like every year I want to make like 7%, I'm just comfortable with that, you can set that up easily. A lot of us like to go for the gold and we don't have the stop losses. We hold the equities naked and we hope that they perform well over a 5 or 10 year period. And they do over a 5 or 10 year period, average like almost a 9 to 10% return. So yeah, especially if you buy now. If you buy in a recession in the following subsequent 10 years, typically you'll get extraordinary returns of like always double digit, but average like 15, 20%. So the best time to possibly invest and start investing is now. So open your stock accounts, start investing. Okay, next question. Boom, boom, boom. David says, I just purchased a primary residence. Former show home, fully finished garage as it was the sales office. It's missing floor and trim. Would you recommend finishing? And if so, what type of floor? Well, depends on your zoning. You might not be allowed to finish it fully, but it depends on what you're using it for too. Like if you wanted to use that garage because there's no basement below it, garage is a poured on slab, just code there are some houses where you can reinforce and have space underneath the garage, but almost no places do because the amount of reinforcement cost is very high. It has to be able to be weight rated to hold cars and everything else. So for the most part, it's on a pad. Which means there's no one below you. So from a sound perspective, it can be a great place to put an auxiliary unit. However, you probably don't have plumbing roughed in, so I would say it's just like a bonus space. Could be a bedroom that you rent out and generate a little extra cash flow in this recession. Cool, you know what I mean? Like, yeah, if it's already finished, why not? But what are you going to use it for? Are you going to, if you're just going to park a car in it, no. But if you're going to use it as an extra room, extra space, go for it. 100%. I'm all about creating extra finished living space. It's properties sell based on square footage in a lot of cases. So if you can create an extra 200 square foot, it could, lead to some extra resale value. That said, though, if the market prices in having a garage on that house and you no longer have a garage, it could be a value loss in some cases because people value the garage more than they value that extra living space. So the answer is it depends. It's very situational. Port City says, would you lock in a 3-year 6.19 on a cash out refi? I just did a 2-year fixed at 5.19, and we're looking at a 3-year fix right now on another property at, I think, 5.75. So it's in the range, a little high, but I think, so my thoughts are this. Right now, in the environment we're in right now, all the data that I have, I think it's smartest to do a 2-year fixed right now. So if you get a 2-year fixed under 6% in Canada, lock in, fix it. We are in for more pain. And by the time they finally fix and they stop raising rates, I think we'll be at somewhere between 8 and 10%. And then the time for it to go back down to 3 is going to take another year and a half, I think. So we may be looking at 2024, maybe 2025, where everything's fully back to where it was. We may not even have that. It may keep going like a seesaw for a while. And so the conservative thing to do, in case the worst case scenario where they can't get inflation under control and rates continue to rise and they continue to stimulate and give money out, which I think they'll do, so the rates will have to go even higher. What I think is that locking in for 2 years is smart. They let you renew after 6 months for free. So you can always renew a contract in Canada 6 months early. So if you lock in for 2 years, you're really locked in for a year and a half with the you're locked in for 2 years with the option to renew it a year and a half. And I think by a year and a half from now, we'll probably start seeing rates lower than they are now. And so 2-year fix is smart. With variable right now, we're going to get a bunch more jacked up prices. So if you lock in on a variable like, oh, it's great. It's only like 5.5% right now. It's going to get to 6, 6.5, 7. And so for a while, it'll be worse. And so if you value your cash flow short term, I think you'll probably win doing fixed versus variable. Don't do a 4 or 5 year fixed for sure. I think that's a bad idea. I think you're smart to just do a shorter year fixed, or go, if you're going to do a 5-year fixed, I think you better go variable, to be honest. I think the variable wins out over a 5 or 6 year term. Over 2 or 3 years, I think the 2 or 3 year fixed terms win out. Here I am. I sold a lot of my properties earlier this year. I had 2% fixed mortgages, 2.4% fixed mortgages. I had a 2.99%, and I paid insane money to break out of those in February 1st of this year. I feel so bad because I paid insane breakout fees to get out of it. And now, I wish I had those mortgages. I wish I could have ported them or done something with them because they're like solid gold now. If you have a locked in 2% 5-year mortgage, that's amazing. At the time when I broke it, it was expensive to break it. Now it'd be free to break it because the bank wants their money back when they've lent you at 2%. They're happy to redeploy it at 6, right? So, here we are. No one has a crystal ball, and the variable didn't win out. I thought it would. I had a variable 1.24% on my house, and now it's after today's hike, it'll probably be up to 4.8 or something, a 5-year variable on my house. And so it's still not that bad. I can easily afford it. It doesn't affect me really one way or the other, but it sucks. It would have been nicer to have it fixed in at 1.5% like I could have done. Didn't have a crystal ball. Thought the government would get a handle on inflation. Everyone I had talked to was like, government get under control. Don't worry. Inflation's going to be fine. The government can't sustain rates at 10%. Businesses can't sustain rates 10%. And they can't. It's going to be painful. But they will to get inflation under control. So it's the reality of where we are right now, guys. Does it make sense to invest in a GIC now? I say no, not yet, considering that the market is moving downwards. I think GICs are not a great investment. I think there are a lot of better places you can invest your capital. You could do lending, like private mortgage lending, where you find a house loan. Don't go more than 80% loan to value, please. If a house is worth $1 million, you lend more than $500,000 or $600,000 against it, and be in the first secure position. If you're going to be in second secure position, no more than 60% loan to value. That will protect you. That'll make sure you never lose a dollar, and that's important. I want to get the risk level. You can get private mortgage lending risk level comparable to a GIC. In fact, I would argue even less of a risk, because at a certain point, the government literally steps in and supports real estate. It's one of the number one, if you include all the tertiary industries around real estate, it is the number one driver of GDP in Canada, if you include all the tertiary stuff. So real estate falling the way it has, and the pain around that will lead to contractions in GDP and actually put us in a recession. So that's just a reality of what's happening right now, and why I think real estate won't go that much lower in Ontario, where we've already seen 25-30% drop in prices. It'll go 10% lower, I think. But there is a bottom, there is a floor. And if you're investing in mortgages and quality properties, you'll be just fine. Martin says, starting to rent out a secondary unit at my primary residence. When is an appraisal needed to avoid capital gains in the future for asset increase in the years prior to renting? So what I've always done is just had like a realtor come in and give me a CMA, a current market assessment, get two of them to come in and give you, independent realtors give you a CMA. That should be enough to send to the CRA. I don't know. Technically, you're supposed to get an appraiser, so go hire an appraiser to come in and appraise it. Try to get as high of an appraisal as you possibly can, especially in this market where like prices are actually falling over this time. You, in theory, could lock in a certain price, then decide to rent your primary residence out, and then the price drops, you get to deduct all of that loss, and then you can live in it again as it appreciates back up. So in theory, you could actually use that. House hacking in a down market is amazing because now you get to deduct that capital loss for that time. And the time where it appreciated, you lived in it, and it was capital gains tax free. The primary residence exemption is the most powerful tax vehicle we have in Canada. It is unlimited. You could buy a house for $1 million, it can appreciate to $10 million, and that $9 million capital gain totally tax free. The best tax vehicle we have in Canada. If it gets misused, people don't, they don't invest properly in a great primary residence. They don't focus on maximizing the value of their primary residence. But when used effectively over a long period of time, it is one of the best tax shelters that we have. Followed second by, I would say, it's pretty nasty what you can do with the TFSA, tax-free savings account, over time, but the amount you can put in it's very little. Like the TFSA isn't moving the needle unless you're like, if you're a poorer individual or you don't have a lot of money, the TFSA moves the needle. But for someone who's wealthier, like I guess over your whole lifetime, if you max out the contributions to your TFSA, it should, over the long term, it should become $1 million or $2 million by retirement. So then it will be a pretty cool vehicle over the long term. We just haven't had it around long enough. It's been around for like a little over a decade. So most people on their TFSA have 100 grand or less, 200 grand or less. So it's not a huge vehicle, but it will become a huge vehicle over time if they allow it to continue. So it's the second most powerful vehicle we have in Canada from a tax-free investing perspective. And you want to use your TFSA specifically for lending out mortgages and doing interest rate type investments, because interest is taxed at the full marginal tax bracket, whereas stocks and crypto are taxed at half tax-free, half of the marginal tax bracket. So any capital gain type of investments, you don't want to do that inside your TFSA because it's already half tax-free. That's how capital gains are taxed in Canada. If you have crypto doubles in value, you don't pay tax at 50%. You pay tax at 50% times your 50%, if your marginal tax bracket is 50%, then you pay 50% times 50%. So your effective tax rate on capital gains is maximum 25%. So capital gains are great. They're a great way to earn income or build wealth over time because they are such tax preferred ways of earning an income. If you earn it from a day job, your max taxable MTR, max marginal tax rate, couldn't get it out, sorry. Your marginal tax rate. Whereas if you had a capital gain of $1 million over the same amount of time, you've retained about twice as much of that net of tax. So earning as a wage cuck, a salary employee, it's not a great way to build wealth. The best way to build wealth is through capital gains. But I lost my train of thought now. I don't know what point I was making. I've lost the train of thought now, but on to the next question. I think I answered that question sufficiently about the primary residence. Stickman Finance says, Mike, can you repeat that? I don't know what I was going to repeat, but he goes on to say, my car is a 2006 Honda CRV with 80,000 kilometers. Should I sell and buy a newer model? What does depreciation accelerate after 100K? So it depends. Every car is different. The depreciation schedules of every car are different. The way that you go about building that curve, you can find them online, but if you can't find the curve, you got to build it yourself. You go look at cars a couple years before that, at that exact age. You just go to that year and that model, and you can look at cars in the low kilometer range, mid kilometer range, and high kilometer range, and you can see how that car has aged and depreciated over time. And you can do that with models ahead of it as well to see, compare the differences. And you can see how the depreciation curve has affected that car from when it was bought to where it is now. And typically what you see with car depreciation is there's like a big steep fall off when you first buy it, then it sort of flatlines for a bit, and then it falls off again, and it falls off again, and then it's pretty much flat. So if you can buy the car in the flat segment, or you can buy the car in the flat segment here and sell it before the last jump down. Typically 100,000 kilometers on a lot of cars is when it drops down. But yeah, effectively that's how you would buy a car and sell a car within the depreciation window. So like my van that I got, I have to sell it at like 90,000 kilometers and get another nicer van to stay in the depreciation curve where I can sell the van for maximum dollars and upgrade to a new vehicle. That's how you would car hack or is ride the depreciation curve of a car to have very little transportation cost. Again, at my level, it doesn't really matter. It's not a good use of time, but it's something that I'm still passionate about. So when you say do your numbers with depreciation, would that be for buy and holds or just bars and flips? For everything, default name. For every property that you buy, any business you buy, a lot of people are running their models with showing appreciation for the next 2 or 3 years. That's a mistake. And they're buying buy and holds that don't cash flow in markets like Toronto, GTA, even in London, that don't cash flow well after you factor in all of the contingencies and the extra costs. And they're banking on simply appreciation. And that's a mistake. I think you need to be making money day one. If you can't sell the property for more than you bought it for day one, you got a problem. You weren't buying smart enough. So right off the top, that's what I'll say. Hey, no problem, Kara. Alex says, which car insurance company do you use? So I've flipped around a lot. I used to be at Balash Monex. Currently we're with cooperators for our car insurance and our primary residence. My rentals are with a insurance broker who did a commercial contract on my rental stuff. So it's, I have more than one provider, but cooperators got crazy expensive for my rental properties. And so I flipped them over to the commercial policy. Yeah. So that's what's up. Yeah, that's what I'm doing. Honestly, I haven't optimized in a couple of years, but at the time that I did it, I was able to do like I think for my daughter, I set up a $25,000 whole life insurance policy, and it was like $200 a year. And when I got triple protection, so you have home, life, and auto with cooperators, they give you like an extra 20% off or something. And adding on a whole life insurance, the smallest whole life insurance policy possible for my daughter, actually I paid $200 a year for that policy for her. It dropped our insurance premiums by like $3,000 a year, I think, across the properties in the car and everything. So the insurance, by adding life insurance to the policy, I was able to effectively make a 20x return or something on that investment. And there's cash value in that policy for her at some point in the future. So for me, it was like a no-brainer to set that up. So just ask questions, think things through, and there's always a way. What happens when a variable rate mortgage hits the trigger rate? Well, it resets and you pay more. And that's coming, by the way. That is a lot of, as those reset in the coming months, as the rates continue to hike, people are already teeter-tottering on the line of it being reset, then they will have new payments, and a lot of people can't afford. So that's a real catalyst for further selling and a further 10% drop, I think, in the price of real estate. Possible. If you're buying smart, 10% doesn't affect you that much. If you buy properties at 60 cents on the dollar, you don't care, right? You have enough insulation, enough room. Can you explain the wholesaling, process? Once you've signed your contract that you'd like to sell, where is the market to sell the contract and how does the exchange occur? So in theory, this is what happens. You put an offer of purchase and sale on a property. You put in a clause that you can then assign that property. In the appendix, you put in a clause that gives you the right, without permission from the seller, that the buyer, you, can assign the within contract and all of its contents to any party you'd like. Now you'd call around a few people, say, hey, I want to buy this contract I have effectively. And then you do an assignment agreement, which is like basically goes attached to the original agreement. It's another effectively like kind of like an amendment, but it's basically a schedule you'd add on that is a assignment of sale and purchase. You put their name in there and you'd effectively assign the contract. You'd add on the price that you want to get for it. So if property is $500,000 and you want to make a $50,000 fee, you'd add on a $50,000 fee. They're happy to pay $550,000 in total for the house, the $500 for the house and the $50,000. They'll give you a large deposit. They'll take you put a deposit up when you lock the contract up. They'll replenish your deposit and hopefully give you a further deposit, because if they don't close, you're gonna get sued because you locked up the contract, not them. And depending how you wrote your contract, you can be still liable if they don't close. So just remember that. A lot of wholesalers get into it with no money be careful. Be careful. There is risk there if you don't write the contracts properly. And even if you do, there's still some risk there. So yes, I guess they would just be sued by you, and it'd be sort of like you get sued, you sue them. But anyway, you sign the contract. They would, in theory, be happy because let's say the properties in that street are all selling for $700, and you got one for $500. They're happy to pay $550 because if they go on the open market and call some realtors, they're going to pay $700. So they're happy to pay $550. So it's a win-win for everyone. That's what you create with an assignment of contract. Next question. If you have a single family house and you need $150,000 to do a duplex conversion, would you do it now and accept the risk of uncertain ARV? Or would it make more sense to rent it out as a single family to one family to break even? Convert it, but do it cheaper. That's my thought. It's almost always worth it. The increase in cash flow over a 5 or 10 year period is almost always worth it. And there's almost always a payback on the renovation as well. So not only do you get more cash flow, there's also a payback when you sell or refinance down the road. What do you think of the Ford government removing local bylaws to build more homes in Ontario? Oh, I wanted to say this. I shared this on my Instagram stories yesterday. Doug Ford came out, Premier of Ontario, and said that all properties shall be allowed to have 3 units on a property, which is like, yes, this has been coming for a while. I'm thankful it's here. It'll make a lot of the illegal triplexes or non-conforming triplexes conforming because now zoning can't do anything. The problem is there still are bylaws that will stop you from being able to do it. As an example, in the city of London, if you have a property, and there are a lot of properties in the peripheral of London that have been absorbed into London, or older properties that are still on septic or well in some way. If you're on septic or well in London, you cannot do secondary dwelling unit even. At all. That's what they've decided. Ford needs to put down some rules and shove it down their throat and say, we are allowing multiple units regardless on any property. They're talking about new development land, but we need to talk about the retrofitting of older properties. Or imagine if you're on the edge of London and you want to put a guest house in, like a detached guest house. You should be allowed to do that with a building permit. But they're going to say no because you're on well or you're on septic or because you're in an area they don't like. And it's not even a zoning issue. It then just becomes a building issue. So they're saying you can't service the building properly. And it's like, what? You can't service it with well water? My house is serviced with well water? What? Anyway, there are loopholes and problems, but it is great. I'm glad to see the movement. I think it's much needed. We have an extreme demand side problem mixed with a supply side problem. So there's too many immigrants. I don't know if there's too many. That's the wrong way to say it. Trudeau is focused on bringing in lots of immigrants. And so we have more people coming here than we have houses for. At the same time, through COVID, they made it really hard to build. And now with interest rates being very high and real estate crashing, no one's investing in building. So there are no new units coming online. Prices are falling, so no one's investing in real estate. There's a supply-demand imbalance. There aren't enough units, so we need more units. And so making it easier to make legal the existing triplexes that are not legal in all around Ontario, there's tons of them everywhere that are legally duplexes, but physically triplexes converted 50 years ago, but the city's never blessed it, and they refuse to bless it because of some bylaw issue or some zoning, not in my backyard bylaw from 25 years ago. There's a lot of those properties. Like, I think a third of rental properties, I came across the stats, like a third of them are illegal in some way, meaning they're like triplex that is zone duplex, or a fourplex is like zone triplex. So a lot of those properties could come online and be legal, because the city shuts down a lot of these units based on, it's only complaint driven, by the way. So the only time you ever get in trouble with bylaw is if you have a piece of shit neighbor who's calling and infringing on what you're doing, or at your rental property is calling and infringing on the tenants there that are pissing them off. So it's that's just how it works. That's the real world of bylaw. And I get why it's there, it's trying to preserve neighborhoods, but neighborhoods need to have multiple families in them. That's a reality of living in a major city in Canada, where we have a supply side housing crisis. We need to be allowing lane homes everywhere, any house. We need to be allowing basement apartments everywhere. Even if it's not 6'5", they still will not, even though Doug Ford's rule says you can do it, if you have an area in one corner of the basement that's below 6'5", anywhere, even if the rest of the basement's 7'5", you have one area where there's ducts or something that stop it, that's technically not legal. And it's a building code issue. So even though zoning might allow you to have 3 units, when you get the building permit, you'll pay them for the building permit, you give them the drawings, and the inspector will walk downstairs and he'll say, this fails. Underpin. It's like, I'm not gonna underpin. Why didn't you tell me this before you had the permit open? I've seen so many horror stories of this. It's just, there are short people out there. Just put a caveat of at one point in this basement it's 7.5, but at one spot it's 6.5. And so the person living here has to be shorter than 6.5. Fine. Like, there's tons of 4'11" ladies that are fine to rent that unit, right? Like, why take that house off the market? Then literally the city will ban you from renting it. As in, like, they'll put an order on the property. You cannot rent this out to anyone. Period. Caution tape. Why? Because in one area of the basement there's a duct that hangs low? Are you kidding me? Anyway, I think it's stupid. It creates supply side issue that doesn't need to be there. But I get their intention, and their intention is good. And they're trying to have great quality housing for everyone. And that's their intention with these bylaws and these rules. And they're trying to make it safe for everyone. Because if a guy's 6'7", he doesn't want to bang his head on the way out in a fire and get knocked out, right? Like, I get why the rules are in place. Just there should be more exceptions, I think. It should be easier. But it is what it is. Alex says, Mike, do you find more off-market or on-market MLS? I guess 6 cents on the dollar is mostly wholesale. Yes, but you can find stuff on-market occasionally that's really poorly priced, and you can snag it up quick, and it can be a really great lift. So sometimes on-market, especially with bad agents. You want to look for agents that don't know how to price houses well, or sellers that don't know what they're doing. Primarily, it's the agent has to be bad. Thankfully, a lot of the agents are bad and have bubblegum licenses, and they're like high school educated, have no analysis background at all, pull bad comps, don't care, they're busy, whatever, it's got something going on, and you can take advantage of that fact, that some of the agents are part-time and don't know what they're doing. Unfortunately, that's just a fact of like how you score a really good deal. Or it's a really motivated seller. Those are basically the only ways that it happens. Let's say if two investors are disciplined with their money over a 30-year period, one strictly invests in rental properties, the other index funds. Who wins simulated 100 times? Christopher, always the real estate investor. Always. And okay, not always. Real estate market collapses at the midway point or the end of their journey on a 30-year period. That could have disastrous consequences. At the start of the journey, if they got a couple of properties and then the market crashed, they could lose their down payment or whatever and be underwater for a while. They'd probably win over a 30-year period either way. So no, yeah, real estate would always outperform, assuming they're doing it in the right area with the right analysis. Two landlords created equal. One gets a 10% compounded annual growth rate. Another one gets a 40% compounded annual growth rate because one buys only single family houses. Loser. Like, all they do is buy single family houses. They have no cash flow, and they go through a recession. This person is only triplexes, and they only do lift strategies. So they buy under market value, they renovate them, they transform the property, they add units, whatever. That investor makes a lot more. They double and triple their down payments every time they do a deal. They burr it and they do another deal. So it depends on the real estate investor, but if you invest the way that I invest in real estate, you're an active real estate business, you will crush the index, crush it. But you got to put your time in. And it's annoying. Like, you got to manage contractors and deal with theft and fighting and all of the issues go along with that. But an index is passive. So obviously the index is going to lose, but it's going to feel better to make money from the index than it does from the real estate portfolio that requires a lot of your energy, right? So you put your energy in, you get a way better return. I'm not buying properties unless I'm getting a 25% return. I'm never getting a 25% compounded return in the index. The index is doing like 8% compounded. So 25% compounded minimum. That's if I do a shitty deal. If I do a good deal, you put 20% down, you burr it, you pull all your money out in year one, you're at 100% return year one. And then obviously you'd either sell the property or sell it and buy two more. It's typically the way you would do it. But you could keep that property, refinance it, and keep going. That strategy yields a lot more than the passive strategy. But this one's a business. This one's requiring your energy and your time and your stress and your sweat and your risk. Whereas this one's like, set it and forget it and don't look at it. So teach their own. This one's not retired, really, unless you got a really good team that you're paying top dollar to, in which case your 25% or 30% compound annual growth rate probably comes down to like 15. If you like completely outsourced everything, then, except for the deal selection, then you'd probably get closer to index returns. Like, you get like what a REIT does. A REIT has all the expenses associated with doing it at scale and making it outsourced. You buy real estate investment trust and you should get closer to index returns. Like, you can just go buy REITs and you can run the analysis of REITs. REITs do tend to outperform the last 10 years specifically because we've been in the bull market. The REITs have outperformed the indexes compared to like the S&P 500, but it depends. It depends. Is real estate a better store of value? I think yes. But both are, I mean, you're owning companies, underlying profit in an index as well. So both are great. You're owning underlying assets in both. So both are fine. All right, I gotta wrap this up. One more last question. Okay, fine, I'll do it. Private banking. I love private banking. For real estate investors, which private bank do you recommend? What are the typical minimums? So every bank has a private banking division. Ugh. Every bank has private banking divisions. All the major banks have them. Typically, it starts at $1 million, $2 million on invested capital, and minimum $1 million or $2 million in mortgages is what they look for to consider you private banking. But you're not really private banking until you're $5 million or more. We get the real perks. At that level, you don't stress test. You don't qualify using your income. You qualify using your assets. And so you can stick up mortgages and buy properties as a real estate investor, being a high net worth individual. I buy property and get quality A-lender mortgages based solely on my net worth and my entrepreneurial ventures. So it's possible. It's great. It's a necessary evil to have your money locked up with them. They don't invest it as well, and they take a fee as well as you can invest it. They're just like index investing basically for you. And they take like a 0.75% MER. And it's a drag on your portfolio, but there are perks. I mean, I get a line of credit secured to my stock portfolio that I could use. There are perks. And so it is a good tool, I think, in the tool belt to have private banking. It is also really nice that I literally send an email. I'm like, hey, can you bring a draft to my lawyer for me? And they'll cut a draft. A physical person will walk the draft to my lawyers and deposit it when I'm closing a deal. So I don't even go to the bank anymore. I'm in private banking. Let's say I'm at Bank of Montreal or I'm at Scotia. I don't physically go into the bank anymore. Do it all digitally. If I need to bring a draft to someone, I call them and they just courier it for me, included in my plan. So private banking is a nice perk. It makes things a lot easier not having to go to the bank, but it comes to cost as well. So, all right, secret to unlocking your wealth through you. 3 levers and control your financial future. Spend less, earn more, and maximize returns in the difference. Bye, everyone. And go check out, Matt McKeever has a live stream going right now for real estate. I can't be on it, but go jump on this right now and say, here, because Mike Rosehart said, or Mike Rosehart said to come check it out. Go do that for me. All 40 of you guys watching this, go check it out right now. And just say, here, because Mike Rosehart. And he'll appreciate that. So it's a real estate panel or something they have live right now, which is pretty cool. So thought I'd push that over there because it's happening right now. So just jump over and watch that instead. All right. Peace, guys.